Welcome to Technical Analysis Lesson 4. Previously, Technical Analysis Lesson 5 was the name, but we updated it to avoid any confusion. This is the fourth lesson in our Technical Analysis course. So at this point, you should have already taken the other three along with the quizzes and reviews, and make sure that you got a passing score at least above 85% on each of those. And if you've gotten 85%, go ahead and retake them and work your way to getting 100 using the reviews. So now, let's go in here and let's start from the very top. Technical Analysis Lesson 4. Let's start here. If you watch the live trades, you'll see that we list it out literally every day. And from here, we started October 25th with this list. And I want you to make your own list, whether it be in a Google Doc or a Google Sheet, so that you can keep track of all of your trades. So you know when you win, when you lose, and when you decide not to trade because you don't get a clear signal. So these are all of my wins and losses with the dates, and you can go and check back with the dates and show with the live streams and say, okay, you can rewatch every single one of these. Now, I put them in an order, and you can see all the way down here on the bottom that there's the green, which are the wins, the red that are the losses, and then over here in white, we have our net. Now, there is significantly more wins than losses because in this strategy, the priority is to keep the losses down. And again, all of this was done in about a 6 to 7 month time span, starting on October 25th, where we started keeping track of the actual numbers. So again, you can see how the wins at 40,000 was significantly more than the losses of about 1,400. Why? Because some days I was willing to not trade because I didn't get a clear signal, and I prioritized keeping my losses down. And then the wins have basically unlimited upside, but the losses, I predetermine what I'm willing to lose. And this is what keeps me way in the green, even on days when I'm willing to take $18 in profit. Some days are thousands of dollars in profit, and some days are very small, but we got to keep the losses extremely small. Now, with that being said, let's get into it, and let's start here. What you need to identify when you're starting with this strategy that you're learning, a breakout strategy, is the current moving candle. The current moving candle. And we'll start there, but I also want to show you the table of contents. What you're going to learn here is how to trade with your chart and not with your heart. We want to take the guesswork out of trading so you can learn a trend break strategy, and you're going to see KG's laws of options trading. So now, to do this strategy, the breakout strategy and the trend break strategy, you got to identify the current moving candle. So these here are candles, and you should have been able to identify what you see here with the candles. Remember, the candle is the entire thing. I'm talking about these lines on the top, which are called wicks, and then this rectangle in the middle, which is called the body. So the entire thing from top to bottom is the candle. So you want to identify the current moving candle. So when we look over here, we can see that I highlighted in yellow just for you. And this one on the right, the far right, is the current moving candle. So in real time, you'll see it actually moving when the markets are open, or if you see me trading live, or if you are trading while the markets are open, you'll see it. And there's nothing to the right of that candle because those next candles haven't happened yet. And we want to see what might happen with them and then use that knowledge to make money and to protect ourselves from the downside. Now, remember, let's just be clear here. There's no guarantees on the stock market, so you have to protect yourself towards the downside so that you can be responsible. Now, I'll also say that this video is not financial advice. I can't give you detailed financial advice because I am not your financial advisor, but I can show you the strategy that got me the results that I showed you on the live streams and in that sheet. So now let's continue on and check this out. We're going to create what's called the gamble zone. The gamble zone is an area where anything can happen. It's basically a coin toss, and you don't necessarily want to trade when it can be a coin toss. You want the favor to be on your side. So when you can identify where it's not on your side, you can start to get indicators where it may be on your side. So now, to create the gamble zone, you got to start here. Find the current moving candle, which we can see all the way over here, and I circled it right here in yellow so you can see we're talking about that one. Now we want to identify places to the left, immediately to the left of this candle. Where's the top of the mountain? And we see the first one right here, top of the mountain immediately to the left. And then this one down here, immediately to the left of our current moving candle. where's the bottom? Where's the most recent bottom, right? So you can see a bottom right here, but that's not the most recent one compared to our current moving candle. Compared to our current moving candle, it's literally the next one over, which is the low point. So we have a low point, and then we have a high point up here, like the top of a mountain. So now that we can identify our high point, our low point, and our current moving candle, we can think about it in an analogy like a mountain. If we had our current moving candle at this point, that's right here in yellow, we want to see immediately to the left, what's our low point, and immediately to the left, where's a high point. So we have up here and down here. So now you can see top of the mountain and then this little valley right here. That's where we will put our lines. So let's go ahead and let's start from the top and do it again. You identify your current moving candle. You find immediately to the top of a mountain, and then the bottom as well. So now we're going to add lines right there. So let's go back just one slide and see. Top of the mountain, bottom of the mountain, highlighted it here for you. And then I'm going to put a horizontal line at the top and then a horizontal line at the bottom. And that's what you see right here. So what are these lines? These lines are your resistance, AKA whatever stock, crypto, or anything that you're looking at is resisting going higher than this. There are a lot of people who are selling it up there, pushing the price back down. But when it comes down, it bounces off of a certain level and it's being supported at this level, supported to go up even higher. So with this known, what we want to do is trade with the chart and not with our heart. One way that we can do that is by just changing the resistance and the support into actual words that are speaking to us. For example, we're going to see it like this. Early entry for a call, and I put a 5% stop loss. You can put a 10% stop loss, but just make sure, in my opinion, that you have one. That's what I changed my word resistance into. Early entry for a call, which means 5% stop loss. That's the resistance level at the bottom. Early entry for a put, 5% stop loss. Now, with the call, again, I'm trying to basically take an indicator to say that the market is going up, so that I want to be buying calls. And on the downside, I'm looking to buy puts if it's breaking down from this zone. Now, the reason that this happens is because here, at your resistance level, there are sellers. And at your support level, there are buyers. So just imagine down here by the word support, imagine that you buy into a stock or an option and it costs $90. This means that, you know what, if you buy it here at the support and it costs 90, people are buying it at 91, they're buying it at 92, 93, 94. But when we get to the middle at 95, now we start to see some people start to sell it. They're selling it at 95, they're selling it at 96, they're selling 97, 98, 99, and at 100, they're really selling it and they push it back down. So then we're getting that zone where it can go either way because we have our buyers on the bottom and our sellers who are at the top, and they're kind of battling each other. So now we set our levels again. Early entry for a call, early entry for a put. So now, when you see your gamble zone, which is right here denoted in these two blue lines, our support and our resistance, right? Support on the bottom, resistance on the top. We break out, and we would love to have been in a call option to make money on this ride up. Or even in a stock, because you can do this same strategy with stock too if you are paying attention and you know what you're doing and you're taking your time and putting in the work. What if right here you see, you want to ask yourself, where was the signal? So we see our breakout out of our zone, out of the gamble zone. You ask yourself, where's the signal? Where is it? Where was the signal to get into a call? Right? Because we broke out of the zone. Which candle told us, okay, now I can start to look towards call options? Because we see early entry for a call. We know we're not looking for the put options because we didn't head down towards that instruction, that indicator, early entry for a put. We're looking at early entries for a call. So it's here. When we're looking towards the upside, we're looking for confirmation, it's called. This is a green candle that lives totally above the blue line. A green candle that lives totally above the blue line that is a resistance line, but we renamed it early entry for a call, which equals a 5% stop loss. But again, you can do a 10% stop loss if you have that kind of a risk tolerance. So let's go deeper into it. This is confirmation that we can see again a candle that lives totally above the blue line. I'm talking about the body of the candle, the rectangle, and the lines on the candle, which are the wicks. The whole thing is beyond it. It's beyond the blue line. Let's look here. This is not confirmation. Do you see how this candle is still touching the blue line? This one looks like it may be beyond it, but it's not, because that wick on the bottom is still touching the blue line. And here, it's also touching the blue line. So this candle here is the confirmation, because again, it lives totally beyond that blue line for our early entry for a call level. So what about the other side? When you're on the bottom of the gamble zone, aka you are past your support level or past what we renamed it to early entry on a put, 5% stop loss, or you can do 10% stop loss if you so choose. That's up to you. This candle is confirmation because it lives totally under this level, the early entry on a put. It's not touching the line at all, and it's red. So for the calls, you want it to be green. For the calls, you want it to be green. For the puts, you would prefer that it was red. So down here, for the put options, when you break below, if this one was green, it could potentially jump back into the zone, and that's not what you want. So confirmation, let's just rehash this. When you go below this level and you see how it's coming down below here, but it didn't totally break, it's still on the line. This candle here is totally below it. So then I look at what the charts are telling me, so I don't have to guess. This is an early entry on a put option. So I'll use my 5% stop loss. I have my instructions right there. I don't have to trade with my heart. Oh, what do I think is going to happen? I can trade with my chart. And then I see it red. Now I'm trying to ride the wave down. So now let's start from the top. You're looking for confirmation, right? So you want to look for the current moving candle all the way over here. You identify the one furthest on the right. You look for your top of the mountain and your low point. So your high and your low immediately to the left. So I got my high all the way up here. I got my low right here. And I'm going to put horizontal left to right lines, sideways lines there. And I'm going to name them early entry for a call, 5% stop loss, early entry for a put, 5% stop loss. But again, like I said before, you can use 10%. And then now I'm waiting for my confirmation. So I'm trading and I see it just bouncing in between these lines. And then I look. Is this confirmation? No, because it hit the line, but it didn't go beyond it and live totally beyond it. What about this one? I'm asking myself, is this candle that is currently touching this blue line, is that confirmation towards the downside? Because again, I should be looking for puts here if I'm using this strategy. And you know what? It's not confirmation because it's touching the line. So now the reason that we want to wait for confirmation is because take a look at this. This exact candle where you have no idea what's going to happen next, what the next candle is going to be. But since it didn't touch and live totally beyond this blue line, this can happen very, very easily, where you have the candle jump right back into the zone. So the next candle jumped right back in. So you wouldn't want to be in these puts. Now, this is a situation called a false signal. So there are two kinds of false signals here. There's a false breakout and there's a false breakdown. This is an example somewhat of a false breakout where you can see, okay, we have our confirmation candle right here. It's living totally or above our line and it's green. So let's say we were to jump into an option or buy the stock or anything like that, buy the cryptocurrency. We buy it here. We're trying to ride a wave up. But then you know what? It jumps right back in to the gamble zone again. So you thought it was going to break out, but it kind of did, but it came back, so it was a false breakout. On the other end of that, you can get a false breakdown where you get a candle that is red and it's totally below, so you're thinking you should get into put options, but then you know what? It jumps right back into the gamble zone. So you have to protect yourself from false breakouts and from false breakdowns. How do you do this? You use your stop loss. Your stop loss is what is going to protect you. So make sure that you go and learn how to use a stop loss if you haven't done so already. So when you see a signal, confirmation that you're going to enter into a call, for example, you have to say, okay, let's go through the trade together. You get your confirmation, and let's say that you bought an option that was $100 right when you got this confirmation. So immediately what you should do is say, okay, now I have to protect myself towards the downside. So you go and you get your stop loss. You put your stop loss on $95, for example. You could have put it on $90 if you wanted a 10% stop loss. You bought in at 100, you put your stop loss on 95, meaning after you bought in, you literally went to your order book, you put in a stop order for $95 to sell this thing. If it came down to this price, it would just kick you out. Why would we want to do that? Because we see if it comes back down to this price, it's going to be back in that zone, and this isn't a true breakout, which we would like to play. So sometimes it goes in your favor, though, where you buy it at 100, you set your stop loss here at 95 to protect yourself from it dropping down. And then what happens when the stock just keeps running up? You bought it at 100, your stop loss is at 95. So then now you're way up. This thing is shooting up. What would I do? And what have I been doing to keep myself in profit and to lock it in and guarantee is this. I would move my stop loss from 95 right here. And remember, my buy-in, let's say, is right here at this 100. I would move this purple line, the 95, and I would change it and put it up here. Now that the stock is beyond, let's say, 120, let's say that the stock ran up to 130, 140, 150, 160, or the option 130, 140, 150, 160, you now have the ability to put a stop loss higher than your buy price because the stock or option is way higher than your buy price. For example, let's say that it came all the way up to $150 and you bought it at 100. Now you can move your stop loss to 120, for example, by literally going into the order book. And when you had at 95, you change that order to 120, for example. Now, let's say your stop loss is at 120. You bought it in at 100, but it just keeps going. I'm talking about it's going to 200. It's going to 300. You would just go back into your order book again and change the 120, change it to something that is slightly lower than the current stock price. So then if it ever drops down, then it'll take profit for you and it'll be more than what you paid to get in. So sometimes you'll get stopped out too quickly. This is a limitation of trading with the stop loss, but you'll almost guarantee your downside risk and protect yourself. Now, there's a way to do this automatically without having to go in and manually change it, and it's called using a trailing stop loss. So now, if you go into class questions in the Discord and you type in the words, how to stop loss, again, how to stop loss, a bot will respond to you and it'll give you so many different videos on how to do a stop loss on many different applications. But you can get a trailing stop loss if you are using Moomoo, which I described here in this video, and it'll automatically move your stop loss for you so you don't have to do it. So now, with that being said, let's talk about the laws, the 5 laws of options trading, which could just be the 5 laws of trading in general. But these are not about investing. I don't do this with Apple stock. I don't do this with any kind of thing that I'm holding long term, only with trades. Because remember, I invest into great companies long term, but there's money to be made trading as well. But I have to wear a different hat to trade than I wear when I invest. So there's different strategies that I have to take. So now, with trading, 98% of traders don't profit at all because they don't follow strict rules and guidelines. So then you're going to get that here. You have to accept that you will lose sometimes. Sometimes you will lose multiple times in a row. So to combat this, you want to make your losses small. Small losses make bosses. So part A, you must use a stop loss 5 to 10% religiously. Again, I'm not going to give you financial advice, but this is my opinion. This is how I was able to be profitable in those trades that you saw that I showed you earlier and that I show you on the live streams. And trade with 5% of your portfolio max. Meaning, if you have $1,000, for example, in your trading account, and you take on an option, you're only using $50. And then with that $50, you are going to protect it with a 5 to 10% stop loss. So you might lose $5, you might lose $10 of your entire 1,000. But this is keeping your downside risk way down so that when you win big. And then when you lose small. Sometimes you'll win small as well, but the goal is to keep the losses down. So even if you were to lose a few times in a row, it would just take one nice win to just knock all of those losses back. So now, overnight holds in a bear market is a risk that can sink the ship. in a bear market. So if you decide to hold overnight, which you can do, remember, you're the CEO of your own portfolio. But if you decide to do that, what you have to understand is you're taking on an added risk, because you now take your ability to get out of a trade away from you. You can't use your stop losses in the aftermarket or in the pre-market. And you are stuck in your options until the market opens. So if anything happens in the news, with the government, with any companies, you'll be stuck. And you don't necessarily want that in a bear market. In a bull market, it might make more sense. But in a bear market, you're taking on more risk. Now, understand this. The game is not fair. Technical analysis is going to work 70% of the time. And that's great. What you really need is it to work 51% of the time. So then the edge is in your favor. But since it works about 70% of the time, that's even better. So that means that we can rely on it often. But we have to remember, there are false breakouts and there are false breakdowns. It looks like it's going to break out, but you know what? Things happen. Things change. So we have to put our stop loss on to protect us. What causes these false breakouts and false breakdowns? Oftentimes, news or manipulation. That influences the other 30%. If we are trading Apple stock or trading the SPY or trading any ETF or broad market index, what can happen is the government may say something, or a company may say something that the market likes or doesn't like. And it doesn't matter what your technicals are saying at that point, because again, news will trump any kind of technical analysis if it is big enough news. Now, there's also manipulation. There's an element of manipulation on the market where we have no idea when big institutions, JP Morgan, BlackRock, Vanguard, when they're going to dump stocks into the market and sell, or when they're going to buy it all at once. We have no idea. There's no indicators to tell you that they're going to do that, but they can, and they own a lot. So we have to be prepared for this. And how do we do it? We use our stop loss, and we are cautious about when we hold overnight. So with that being said, remember, 40,000 up, 1,400 in losses on the live streams in trading using this exact strategy that I showed you here in about 6 months. Now, what I want you to do is go and take the quiz. The quiz is going to be posted very soon. If it isn't posted yet, I posted about a week after we get the quiz out. So people have, or actually a week after we get this video out, so people have a chance to actually go and watch it and learn. But go and take the quiz. Good luck. And I love y'all. I'll see you in the next one. Let's get out there and let's make some money. Take care.